target date funds just hit $4 trillion. And many 401ks, they're the default option. But millions of employees really don't understand how they work. So are they the smart way to go? Are they the lazy man's way to retirement? We're going to dive right in. Let me grab Walt. We'll be right back.
Welcome to Power Your Retirement. Walter Storholt here alongside Steve Smith, certified financial planner. We've got a great episode today, Steve, because we're talking about somebody that I would imagine if someone's watching this show or listening to this program today, maybe if we took a look at their 401k or something like that, they might have a target date fund in there. The chances, at least, are that there's going to be one hanging out in there. And so we're making that the topic of conversation today because it came out this year that, in 2024, there's a delay in this data sometimes. We passed that $4 trillion in assets in those target date funds. This was according to a report from Morningstar, by the way. And they say, in fact, the numbers are that 8 out of every 10 Vanguard 401ks, but a good sampling there, they hold one. So the odds are in the favor that somebody's probably got a target date fund hanging out in their portfolio, would you say?
Definitely. They are one of the options, if not the default option today, target date funds in 401k plans, simple IRAs, 403bs, 457, all of those usually have some sort of lifestyle or target date fund.
Yeah. Well, what I'm interested in learning about today, and I know we're going to dive into this, is that default option okay? Is this just lazy to choose these defaults? Or is it still an okay way to plan for retirement? Who are they correct for? And when might you want to say, I should be more sophisticated perhaps than just the target date fund? So that's what we want to dive into a little bit. But let's start with some of the basics. What are we talking about for those who don't know when we talk about a target date fund?
Sure. There's no real magic around a target date fund. It's basically a set of investments. There's usually some stocks, some bonds, and it's really just an allocation. So typically a 401k will have a certain amount of active or index type funds in it, and the target date fund will take those options that are already on there that you could pick a mix, and it puts them into a portfolio for you. And slowly over time, it lessens on the stock side and beefs up on the bond side. So that transition from young, which is mostly stocks, to retired, which is going to be, I don't know about mostly, but a significant higher proportion of bonds on this side, and that's that slow trajectory. So it's really age based, and you can skew that by telling it when you want to retire, because it usually isn't like 65 or 60. It's usually you pick a number. So if you want to work till 75, you just pick the year that you turn 75. So that
gotcha.
So that's
so
how
inside
that works.
Your 401k, you might see it as the 2025 target date fund and the 2030 and the 2035, or are they spaced out by 5 years, or does it just kind of depend on where you're selecting?
It can depend, but that's the most popular way to do it. So if it's 2025, it means you're retiring this year. At least you probably should be if that's your mentality of how you're doing this. If you're 2030, that means you've got 5 years out before retirement. And that in and of itself has some issues that we'll get into for sure.
Well, yeah, I definitely want to dig into some more of those reasons of why we might want to consider a target date fund or not in today's landscape. But still looking back and kind of peeling that onion a little bit further, why have they become so popular, Steve? Why have they become this default option in so many plans? I mean, if we're at this $4 trillion number and counting, I mean, there's got to be a reason that this has become ubiquitous across the investing landscape.
There's a very good reason for that. And the number one reason why I believe that they become so popular is most employees know that they need to invest for retirement through this 401k vehicle or 403b or whatever it is. They know they need to, but they really don't know how. They've never been trained. There's a lot of weird words in there, like growth and value and small and large and mid and international. And then you've got all the sector funds that they throw in there. And all this stuff is just very confusing. And most 401ks do not allow you to work with an advisor. In fact, all they give you is a prospectus that will either put you to sleep or give you a headache, depending on who you are.
I like that. So we're you provide something to people that's the easy way to do it. Many are going to choose that path, and that's not necessarily a bad thing, but that certainly seems to be maybe one of the main reasons this became so popular and easy to make the default for so many folks.
Right. You just pick the year you want to retire, whether you can or not, who knows? But the point is, you get to pick, say, hey, I want to retire at 65. You match that up with a date, and you're done, and it does it for you. That's easy. And that not knowing, how to invest or how to put a portfolio together is really what's revving this up, because it's like the easy way that that you're probably going to be okay.
All makes sense. Let's break down some more of the benefits and the catches that come along with these target date funds.
Yeah, so one of the big benefits is that what I mentioned before is that changing from stocks to bonds, that lessening of risk. That's a huge benefit, but also wrapped inside of that, because that doesn't happen instantaneously or every 3 months. So you also have a rebalancing, because stocks are going to go up, down, bonds, interest rates are going to go up and down. So you've got all this going. So there's also built-in rebalancing, which is another reason why people go to these target date funds, because they're maybe watching the balances go up and down and see how much they made or lost or whatever is going on in that particular year, but they're not really intelligently doing that. And what I mean by that is, like, there's people that have the time and inclination to do it themselves, not talking about those folks, only the people who really aren't sure of what to do. So they just, it's kind of a catch-all for everyone. So that's actually a big benefit, because if they're not rebalancing, you're giving up some of that long-term return.
Okay, very good. So what about the things that people should watch out for when working with target date funds? What might not make the brochure literature in terms of what we need to be careful of?
So there's a lot of things to watch out for. Just because you have a portfolio theory, right, of lessening risk over time, and you have a rebalancing tool, which is great, what they don't monitor is, are you putting enough in? Just because you're getting the match, if you are so lucky to have one at your employer, doesn't mean that is going to replace your paycheck. So there's no planning element to a target date fund, because it's really arbitrary. I'm 25 years old. I want to retire in 40 years. I pick 2065. Okay, that's not planning. That's just picking a date out of the sky, which is kind of a normal date, 65. Medicare comes on. I mean, I'm not saying that's a bad age to retire, but there's a lot more that goes into this rather than just a theory and a date at some point in the future. So there's really no advice there of how much they should be putting in, and there's no cross-reference to how much they were able to get ahead in their 20s versus their 30s, how many kids they have, businesses they own, inheritances they get, is the spouse working or not working, and have their own employer plan. So the list goes on and on. So there's a bunch of things that kind of leave that theory wanting. Now, it's still a catch. So it's better than just randomly picking off the list or throwing darts on a dartboard. I'm all for the target date fund if you're deciding not to get help and you don't understand. At least it gives you a structure. So that's good. But then we also have certain employers that go the extra mile, and they have, like most of the companies that I work with, a cash balance pension. So now all of a sudden there isn't just one retirement vehicle, you have two. And when we look at how those work together, your traditional target date will actually significantly hurt that growth over time, because it's not, the target date accounts for as if it were one entity unto itself, not one of two. So even in there, it's a very big deal. So you want to work with an advisor or work with someone or learn it yourself on how those two go together, or you can easily leave a lot of money on the table, especially in your last 10 years.
As an opportunity to maybe wrap up this conversation, Steve, I'm just curious, do you have an example, since you work with, and this podcast is designed specifically for folks who are employees of large publicly traded utilities, do you have any examples where somebody's come to you and wanted to become a client, and you looked at their portfolio and it was this exact situation, just maybe a couple of target date funds that have been picked, and then what'd you do with their specific plan to kind of draw out something that was a little bit of a better fit and would lead to a better outcome for that person?
Yeah, just generically, we had Todd, which is a client, came on several years ago. He was around 50 years old, and he didn't really know what to do. Was in a target date fund, just like what we're talking about, and that glide was already starting to go towards the bonds, and I was able to show him how that cash balance pension, and for those that listening that don't have the pension element, and we're not talking about like a government pension here, cash balance is very different. So people hear the pension word and they're not sure. So if you're not sure about that, reach out to myself or somebody. I can explain that. But those two elements, when they come together, the risk profile for the 401k looked very different when you paired them together. And he was able to go from what he was targeting at that time, which was probably around a 6% return on his 401k. And of course, these are good times. Of course, the last 10 years has been significant. He was able to almost double that return. Can you imagine in your last 10 years after working for that company for 25 years already, the balance that was in there and the difference between a 6% return over, he's not quite to that 10 years yet, but, over that 10 years versus a 12, it's amazing if you do the math on that.
Yeah, great example. Well, it's clear to me that if you have a really simple situation and you want the easiest way, hey, target date funds were kind of built for the person that fits that description. But if you want the best way, a way that's customized and optimized to your unique situation, your individualized approach to retirement, that takes into account more goals, more of the moving parts that you might have in your life, how it meshes in with a spouse's plan, and all these other types of factors, it sounds like you very quickly mature from a target date fund to a more sophisticated plan. At least that's what I'm hearing.
Yes, and target date funds are easy. So if you don't have the opportunity or you're opposed to working with an advisor, I would say a target date fund, you're better off with it than without it, even if you do leave some money on the table later on. If you're in one of those situations where you do have a cash balance pension or a spouse works for a government entity or something of that nature. But I would highly encourage you, if you want to optimize, and I'm not talking about taking outsized risk, I'm like what you should do type of thing versus what's available. A lot of people would be well served in working with an advisor, at least to get the plan so understand what to do. And if you're not quite sure how to put portfolios together and all those other things, then to fully integrate with an advisor will serve you better over the long term, for sure.
Excellent. Well, if you are an employee of a publicly traded utility, you can certainly reach out to Steve and talk a little bit more about the specifics of your 401k plans. He's got great programs in place that are specific to the industry to help you get the most opportunities out of your 401ks. He can tell you more about those details, obviously, when you discuss. A great first step is to get Steve's book and so much more information as well at powerupyour401k.com. That's powerupyour401k.com. We've got that linked in the description of today's show as well to make it easy. Get the book, more resources, all sorts of good stuff there available at your fingertips. So if you haven't gotten those resources yet, get free access today by just going to that link in the description of today's show or at powerupyour401k.com. Steve, thanks for the breakdown on these target date funds and filling us in on some info there, and we'll look forward to talking to you again next week.
Thanks, Walt. Thanks, everyone, for listening.
This podcast is provided by Powerhouse Financial Advisors, an independent firm with advisory services offered through Parson X Advisory Services, Inc., PAS, a federally registered investment advisor. The information provided is for informational and educational purposes only and should not be considered as personalized investment advice. PAS does not guarantee the accuracy, completeness, or suitability of this information for your specific circumstances. Investment decisions should be based on an individual's goals, time horizon, and risk tolerance. Past performance is not indicative of future results, and all investments carry a degree of risk, including the potential loss of principal. Any case studies, testimonials, or endorsements shared in this podcast are illustrative of individual experiences and may not be representative of the experience of all clients. They do not guarantee future performance or success. You should not infer any level of assurance regarding future financial outcomes. Listeners should consult with a qualified financial, tax, or legal professional before making any investment decisions. Parson X Advisory Services, Inc. does not provide tax or legal advice. Be sure to consult with your tax and legal professionals regarding your specific circumstances. For a copy of our Form ADV Part 2A, which provides additional information about PAS, including our advisory fees and services, please visit powerhousefinancialadvisors.com.